Good afternoon, ladies and gentlemen. The Monetary Policy Committee met on the 19th and the 20th of September 2019 in the light of the softening global growth and weaker than anticipated domestic output recovery. The committee evaluated developments in the global and domestic economies and examined the outlook for the rest of the year. It noted the build-up of vulnerabilities in major advanced economies and its spillover to the emerging markets and developing economies. 9 out of 11 members of the committee were present at this meeting. Global economy. Output growth across major advanced economies remained subdued, confronted by legacy headwinds, including the subsisting trade war between US and China, regional hostilities in the Middle East, rising debt levels, growing uncertainties around the Brexit, and increasing political tensions between the US and Iran, including fragilities in the financial markets, all contributed in dampening the growth prospects. In the emerging markets and developing economies, output growth remains broadly mixed, with some economies performing stronger than the others. Consequently, the International Monetary Fund, the IMF, revised its projected global growth forecast to 3.2% in 2019 from 3.6%. Price developments continued to soften across major advanced and emerging market and developing economies as aggregate demand continually weakened, resulting in softening monetary policy by major central banks to address downward trending prices and to strengthen aggregate demand. Data from the National Bureau of Statistics shows that real gross domestic product grew by 1.94% during the second quarter of 2019, compared with 2.1% and 1.50% during the preceding and corresponding quarters, respectively. This mediocre growth, we believe, is consistent with global trends of dampening output growth and was driven mainly by the oil sector, which grew by 5.15%, while the non-oil sector grew by 1.64%. At 57.7 and 58 index points, the manufacturing and non-manufacturing purchasing managers indices grew moderately for the 30th and the 29th consecutive months, respectively, in September 2019. Star projections indicate that real GDP during the third quarter and the fourth quarter of 2019 would average 2.11 and 2.34% respectively, driven primarily by non-oil sector. This optimism in growth prospects is anchored on the new momentum of rising credit to the private sector. However, the headwinds to the growth prospects remain high unemployment, rising public debt, and heightening insecurity across our country. The MPC noted the continued moderation in headline inflation year on year to 11.02% in August 2019 from 11.08% in July 2019, driven by decline in the food and core components to 13.17 and 8.68% in August 2019 from 13.39 and 8.80% in July 2019, respectively. The developments in the food and core components of inflation was partly due to improved agricultural production in the current harvest season, supported by the bank's sustained intervention in the agricultural sector, as well as continued stability in the foreign exchange market. The committee, however, noted the upward pressure imposed on prices due to rising uncertainty in the food producing areas of the country, increased liquidity injection from the FARC allocation disbursements, and late budget cycles. It also highlighted the imperative to address the economy's infrastructural deficits, such as power supply, upgrade of transport and production infrastructure as a means of reducing cost-push inflation. Committee observed that broad money supply M3 grew by 5.65% in August 2019 compared with the level at the end of December 2018, annualized to 8.48%, but remaining below 2019 indicative benchmark of 16.08%. The growth was largely driven by the increase in net domestic credit, which grew by 24.36% in August 2019 from the level at the end of December 2018. The growth in the net domestic credit was accounted for by the significant increase in credit to government, which grew by 94.33%, while credit to the private sector grew by 9.36% in August 2019. The committee urged the management of the bank to explore new initiatives to further implore lending to the private sector, while calling on government to adopt other ways of funding its operation outside the banking sector. In the review period, money market rates oscillated within the standing facilities corridor due to prevailing liquidity conditions in the banking system. The monthly weighted average interbank call and open buyback OBB rates increased to 8 and 13.38% in August 2019 from 6.52 and 11.01% in July 2019, respectively. Committee observed the continued bearish trend in the equities market, while noting the increased activity in the sovereign bonds market, reflecting global trends and investor preference for fixed income securities. In the light of this development, the all-share index declined by 11.62% to 27,779 index points on September 13, 2019, from 31,430.5 index points at the end of December 2018. Market capitalization, however, grew by 15.37% to 13.62 trillion on September 13, 2019, from 11.72 trillion at the end of December 2018. This increase in market capitalization was attributed to the relisting of 2.75 billion ordinary shares by Airtel Africa in July 2019. The MPC noted the improved performance and resilience of the banking sector, evidenced by the continued moderation in the ratios of non-performing loans NPL from 11.2% to 9.4% in May and August 2019, respectively. While noting that this was still above the prudential benchmark of 5%, the committee called on the management of the bank to drive this ratio further below the prudential benchmark. The outlook. The persistence of policy uncertainties, financial vulnerabilities, and rising geopolitical tensions continue to cloud the medium-term outlook. This is evidenced by the sustained weakening of global growth across regions, amplified by the persisting trade tensions between the U.S. and its major trading partners, rising corporate and public debt levels, and growing financial vulnerabilities. On the domestic economy, output growth in 2019 is expected to peak at 2.1% IMF forecast, 2.2% by the World Bank, and 2.27% by the CBN. These forecasts remain underpinned by expectations of favorable oil prices, which will lead to higher external reserves, stable exchange rate, moderate inflationary pressures, as government increases capital expenditure, including enhanced flow of credit to the private sector to stimulate investments, sustain CBN interventions in the real sector, effective implementation of the Economic Recovery and Growth Plan ERGP, build-up of fiscal buffers, as well as improve security in the country. The committee's consideration. The committee noted the decline in output growth in the second quarter of 2019, partly attributable to the delay in implementation of the 2019 budget. It, however, observed that this was an improvement over the corresponding quarter of 2018. In addition, it noted the broad slowdown across key economies and the response of major central banks to revise their policy rates downwards. On price developments, the committee commended the progressive moderation in consumer prices and urged the bank to sustain its intervention in the real sector of the economy to reduce the negative output gap. The MPC noted the improvements in the financial soundness indicators and urged the management of the bank to sustain its regulatory surveillance to ensure continued financial system stability. The committee particularly noted the growth in the size of industry loans from 15.4 trillion in June to 16.23 trillion in September 2019. On the recent directives to deposit money banks to increase their loan-to-deposit ratio, committee underscored the need to grow consumer, mortgage, and corporate credits to drive aggregate demand and ensure a reduction in unemployment and increase output growth. Consequently, the committee urged the management of the bank to fast-track the development of the credit scoring system to promote increased lending in the banking system. In addition, committee commended the introduction of the Global Standing Instruction GSI initiative aimed at de-risking credit in the industry by committing bank customers to repay their loans to banks. The MPC further noted the increased supply of microcredit to key micro, small, and medium enterprises and efforts through the Nigerian Incentive Risk-Based Sharing System for Agric Lending, its microfinance bank, to extend the reach of its credit facilities across the country. Committee, however, observed that the growth in credit to the private sector remains significantly low relative to the absorptive capacity of the Nigerian economy. The committee further underscored the linkage between high unemployment and heightened insecurity, emphasizing the critical need for urgent steps towards more jobs and wealth creation in the country, particularly within our rural community. As an interim solution, the committee called on government at all levels to ratchet up public works programs aimed at easing the threat of rising unemployment in the country. This, the committee argued, would be achieved through efficiency in public spending. The MPC also noted the government's current drive to increase value-added tax, adding that this will improve fiscal revenue to support expenditure and reduce the budget deficit and government borrowing when implemented. Committee noted that this was too little to close the gap in government finances. Consequently, the MPC called on the government to, as a matter of urgency, adopt what it termed a big bang approach towards building fiscal buffers by purposefully freeing up redundant public assets through an efficient and effective privatization process. This would raise significant revenue for government and resuscitate the redundant assets to generate employment and contribute effectively to national economic growth. The MPC noted the unstable oil prices, its implications on accretion to external reserves, and its persistent call on the government to build fiscal buffers. Consequently, the committee called on the National Assembly to exercise restraint from increasing the oil price budget benchmark to avoid budgetary overruns at the implementation stage of the budget. Projections from the oil futures market indicate that oil prices will remain tight around the budget oil price benchmark in the medium term. The committee's decision. In its consideration regarding the policy options to adopt at this meeting, the MPC, as usual, felt compelled to review the options of whether to tighten, to hold, or to loosen. Committee noted the positive moderation in inflation, though slowly, from 11.08% in July to 11.02% in August 2019. Given that this was still above the target range of 6 to 9%, and considering the pressure on reserve creation caused by relatively weak crude oil prices, the MPC felt the imperative to tighten. On the contrary, the committee was of the view that doing so in the midst of a fragile growth outlook would increase the cost of credit and further contract investment and constrain output growth. On loosening, the committee felt that this would result in increased system liquidity and hence heightened inflationary tendencies in the economy. In particular, the MPC was of the view that loosening would drive growth in consumer credit, but without a corresponding adjustment in real sector output. The committee was also convinced that increased liquidity and interest rate moderation will result in exchange rate pressures as money supply rises. As regards the option to hold, the MPC opined that the option requires a clear understanding of the quantum and timing of liquidity injections into the economy before deciding on possible adjustments to the stance of monetary policy. The committee was also of the opinion that retaining the current position of policy offers pathways to appraising the effects of the suit of heterodox monetary policy to encourage credit delivery to the real sector of the economy, especially in the light of the subsisting implementation of the loan-to-deposit ratio policy. In view of the foregoing, committee decided by a unanimous vote to retain monetary policy rate at 13.5% and to hold other policy parameters constant. In summary, the MPC voted 1. Retain MPR at 13.5%, 2. Retain asymmetric corridor at plus 200 and minus 500 basis points around the MPR, 3. Retain the CRR at 22.5%, and 4. Retain liquidity ratio at 30%.
Thank you, Director. My name is Sonia Adejo. Good afternoon, Governor of the House.
Which press?
Nigerian Tribune, sir. Yes, you adopted, although you endorsed the increase in proposed increase in the VAT. And then I'm wondering, sir, in view of how the economy is now, you also admitted, the MPC also admitted that growth is still fragile and there is unemployment. Now, if the government increases VAT, which is consumption, does it not have the effect of discouraging consumption? And if consumption is discouraged, then inventories will rise, and so on and so forth. Thank you.
Thank you. Luka.
Good afternoon, Mr. Governor. I'm Luka Chief of the Nation newspaper. This week you rolled out some circulars, one of which was that there will be, or rather you came back with the return of charges on deposits and withdrawals. There have been pushbacks from the public with regards to this decision. What is your take on this reaction? Thank you very much.
Okay.
Good afternoon, sir, Mr. Governor. My name is Isa Bua from Nigeria. Within the week, you gave out approval in principle to 3 payment system banks. We are aware that some other operators have indicated interest. Can you give us your thoughts on this?
Okay, Chief Mrs. Nancy Naji.
Thank you, Director. Okay, Governor, I just want to tilt from today's MPC with your permission, sir. It has to do with the conviction judgment of P&ID yesterday at the Nigerian courts. The question is, how do you feel about the $45 billion FX reserves that we have? Are we really safe? Because $45 billion should be like 6 to 9 months of imports cover. I want you to comment on that. Thank you, sir. Thank you, Director.
Thank you, Chief. Your name, please.
Good evening, Alonso Soto with Bloomberg. Just one question for the governor. Good evening, everyone. We had the Fed cutting rates this week. We also had
what?
the Federal Reserve cutting
Fed.
rates this week. We also had the European Central Bank loosening the monetary policy last week. I was wondering if you expect an increase in capital flows into emerging countries, specifically Nigeria, and is that a risk? Is there a risk of a sudden stop? Is there a risk of bubbles? And just the other thing, I think there were some comments yesterday about you increasing just FX restriction on cassava products.
In view of the weak economy, if government increases VAT, will it not somewhat adversely create problems or adverse consequences on the economy? My response here is that the government has a responsibility to fend for everybody. In fending for everybody means that it has to spend money to provide infrastructure, roads, airports, railways, and do different things that will improve the lives of our people. But there are two ways through which government can fund this expenditure. It's either it raises revenue or it goes for debt. You all know that the government has been criticized that the debt stock is too high. You all know that government has been criticized that its debt to revenue, debt service ratios are too high. When you say the debt service ratio is too high, it means that your interest rate to your revenue, your interest rate is too high relative to your revenue. And what that also means is that your revenue is small, because if your revenue is large, then your debt service ratios will be lower. Now, so government unfortunately will not have any option. If we say government should not borrow, then government must raise revenue. If government must raise revenue and we think that this should be one way through which government can raise revenue to meet its obligation, then I think it calls to a rationale that what we're saying is that it is the right decision to say that government has to increase VAT from 5% to 7.5%. Sometimes, yes, we agree that this may be painful, but it's important that we understand that government also has an obligation that it must meet, and so it must raise revenue. And what even is this VAT rate? 7.5%. Compare the VAT rate in Nigeria to VAT rate in any part of the world. Nigeria's VAT rate, even at 7.5%, stands at one of, if not the lowest in the world. So I think I would just have to appeal to Nigerians to please try to show understanding. It may seem painful, but again, it's important for us to know that when government spends, because you are looking at the adverse consequence it has on the purchasing power of the person who will spend. But you should also look at the positive implication on the fact that government raises revenue, debt service ratio is lower, government can meet its obligation to improve roads. When government improves roads or provides money for electricity, it will also have positive implication on the GDP and output growth of the country. So which will be better then? I would rather choose, just like MPC decided, that VAT will be a better option to raise revenue. Second, on the cashless, again, I truly sympathize, and truly speaking, and I have read and listened, and so you would imagine that I would have prepared myself for this. Prepared myself because I'm saying I seriously and truly sympathize with the banking public and regret the inconvenience that this may cause, or certainly is causing, bank customers. But let me put it this way. The cashless policy in Nigeria is not new. It was first launched in 2012, and several engagements were held across multiple stakeholders before we started this policy in 2012. Indeed, it was by my predecessor. I didn't start it. At inception, charges had always been on deposits and withdrawals. And this started since 2012. Withdrawal charges have been in place. Only deposit charges are new today, and I will explain. I said at inception, when it was contemplated, if you deposit money in a bank above a particular threshold, in which case for individuals 500,000, for corporate 3 million, you are charged. For withdrawals, if you also withdraw above a particular threshold, you are charged. Since inception in 2012. But it got to 2014, after receiving some engagements from different stakeholders, we agreed that it was too early to begin to charge people who want to deposit money in the banking system, because we agreed at that time there was a lot of cash outside the banking industry, and that there's no need to penalize people who would like to bring their cash from outside the banking industry into the banking industry, that we should relax the essence of charging people for depositing money in the bank, but retain those who want to withdraw cash from the bank. And indeed, I understand that was what India did. But eventually, we expect that over 5 years, from 2014 to 2019, all the cash that would have been kept in people's pillow, under their mattresses, by 5 years, we should have been able to bring them back into the banking industry. And that's why we're saying at this time, we would like to return back to that. So what I'm saying is, what we're saying today is not new. But by March 2020, we're saying that now we're only returning back to the 6 states where currently withdrawal charges are holding. There are 6 states. It's not all over the country. But the entire cashless process will have to permeate the entire Nigeria by March 2020. Okay? So this policy is in no way designed to disenfranchise hardworking Nigerian businesses, as some of the media analysts have been saying, many of whom have indeed embraced electronic payment channels and online digital marketplaces. Today, permit me to say that small and medium enterprises and other businesses have various options and channels available to them for collecting legitimate payments for goods and services, like bank transfers, using the POS, using the mobile POSs or mobile cash, mobile money, the USSD codes, and the QR codes. Indeed, it is in the public interest to promote an efficient payment system via the cashless policy, which helps to reduce the punitive cost of cash processing, often passed on to bank customers via deposit money banks. Cashless policy also improves transparency in financial dealings and reduction in crime, such as advance fee fraud, graft, ransom payments, and extortions. It is in line with the CBN's quest to adopt international best practices and international conventions, especially in view of the recent reputational damage with some Nigerians perpetrating advance fee fraud, that we think that Nigeria must proceed in the direction of cashless economy. The Central Bank of Nigeria's mandates and responsibilities under the CBN Act of 2007 amended empowers it to promote a sound and stable financial system and credible, efficient payment system. And I'm talking of Section 2D and Section 47 of the CBN Act. And let me go to some specifics. A pilot was done in August in Lagos, as we were starting cashless in 2012, before the policy became effective in July 2013 in Lagos, Ogun, Kano, Abia, Anambra, Rivers, and the FCT. Fees on excess cash withdrawal are not new and have been in place since July 2012. These deposit fees are also not new. They had been in place since inception, but later withdrawn in 2014 following feedback on the need for stakeholders to fully embrace electronic payments before implementation. And we believe that after 5 years, and with all the options and channels that are currently available, that we need to really embrace best practices by actually saying that we should go cashless in Nigeria. Unfortunately, data between 2012 and 2018 reveal that the cost of currency management in 2014 reduced by 13% when we first introduced it, when we were talking about deposit, right? Due to the introduction of the full cashless, including charges on both deposits and withdrawal in the 6 cashless states throughout 2013. From 2015, following the withdrawal of the policy on deposit charge in 2014 through to 2018, currency management costs have continued to increase year on year at an average annual growth rate of 33%. That is certainly too high. Notwithstanding, since the cashless policy was first launched, electronic transactions have increased substantially within the economy. And we'll give examples. For instance, POS transactions increased by 4,692%. And we're talking about 2.27 trillion naira from just 48.6 billion in 2012 to 2.3 trillion naira at the end of 2018. Second, electronic transfers increased significantly by 1,967%, and I mean 76.5 trillion from just 3.8 trillion in 2012 to 80.42 trillion in 2018. Check transactions have reduced by 32%, by about 2.45 billion from 7.48 billion in 2012 to 5.03 billion in 2018. Financial access points, ATMs, POS, agents, and mobile cash across each cashless policy states, these 6 states we're talking about, have also witnessed exponential growth. So what we're saying is that we have provided alternative channels and people have indeed embraced it. Another data conducted before we even came up with this limit says that close to 95%, so when people talk about other SMEs or the weak or the vulnerable are going to be badly affected, close to 95% of cash deposited or withdrawn from banks fall within, that is below this threshold. So only about 5, maximum 10% of people are those who are complaining that this is going to weaken, and they know what that purpose is for, and we don't want to deliberate on that today. Financial inclusion has also recorded significant improvement in Nigeria. According to a FINA survey, today financial inclusion has increased to 65% from just 40% 18 months ago. Whilst inclusion rates in cashless policy states are in line or above the national average as follows. For instance, in Lagos, where cashless is 85%. In Abia is 74%. In FCT, 68%. So the other areas are those that are having low financial inclusion rates, and there's a need for us to deepen financial inclusion, and to do so also means that we have provided enough channels on the basis of which people can begin to go cashless. This is a strategic timing of these actions because on Monday, September 23rd, the mutual evaluation of Nigeria by GEABA on the country's anti-money laundering and CFT regime will begin. Passing the mutual evaluation positions Nigeria as a state, as a safe and credible destination for financial transactions across the world. What does that mean? GIABA will be in Nigeria on Monday, 23rd of September, to access and evaluate the rate at which Nigeria has embraced anti-money laundering and CFT regime. It is important that we display and show to them that Nigeria is indeed in conformity with their practices as enshrined in the anti-money laundering and CFT laws. What does that also mean? If we do not do what we are doing today, we will soon get to a point where if they pass us negative, even your so-called cards that you carry abroad, you may not be able to use them. So it is in our own best interest that we should be seen to be working in line with best global practices so that we can have a comfortable and convenient life in future. What are some of the benefits? Reduction in cash processing costs, which are punitive and often passed on bank customers. 6. Anecdotal evidence of proliferation of e-channels on lifestyles. We've seen it happen. For instance, we've seen a reduction in the use of checkbooks, physical visits to branches of banks because people can easily use their phones and conduct banking transactions. We've also seen on POS, we've seen POS proliferation across all merchant locations, in restaurants, in schools, in churches and mosques, hospitals, petroleum stations, even in petty traders, they have all embraced the use of mobile cash, M-Cash. We've also seen increasing use of digital channels in the sale of goods and services. Some of you even do bank transfers on your mobile phone, even when buying gala and plantain chips in the traffic, and you know it is true. Now, the fees have been reintroduced only in cashless policy states right now, only the 6 states. Okay? And we are determined to ensure that financial inclusion is deepened in the country. Full cashless policy shall be implemented on March 31st, 2020, following thorough multilateral stakeholders and nationwide scooping of financial access points, which have significantly increased over the years. By March 2020, when cashless goes nationwide, there would have been more than 8 years of engagement by the CBN across multiple stakeholders. Since then, payment systems have evolved substantially, with several innovations in payment space, including bank transfers, POS, mobile cash, mobile money, USSD codes, agents, and the QR codes. Finally, on cashless, before I go to the other questions, the CBN encourages Nigerians to recognize the significant strides made so far in financial inclusion. Like we said, 65% according to the latest EFINA report, and as high as 85% in some of the states currently under our cashless policy. Improvements in the number and variety of financial access points and proliferation of digital and online payment channels, such as those that I've mentioned, POS and the rest of them, would naturally help our situation. So, the story is very clear. So I want to appeal. I understand how people feel when new policies are introduced, but I just want to appeal to all of us to please try and see that it is for our benefit and the good of our country. The third question talks about the AIP. 3 AIPs, yes, 3 AIPs have been issued to some 3 institutions. Let me say that it's an ongoing process, but we just felt we must kickstart this process. And these are people that we have seen, or companies that we have seen, that meet our fit and proper test, people who will not breach our regulations, people who will subject themselves to our regulation and not breach them, because we do not want to go through problem of people who want to breach our regulation. And I think we will continue to adopt this. We will not give those licenses to those that we believe will see themselves as being above the law of this country or above our own regulations. On P&ID, yes, it is true there were some issues, some matters came up in court yesterday, and of course, first let me assure us that by the special grace of the Almighty, there is no threat or reserves. And like I had said in some previous interviews, this is a fraudulent transaction, and all Nigerians, all right-thinking and progress-seeking person in any part of the world must condemn a fraudulent transaction like this that would result, that according to the arbitral award, would result in almost taking about $10 billion away from the reserve of a country like Nigeria. And you all can imagine what it will cost. We are talking about a fragile economy. We are talking about a fragile growth. And some people, whether they are Nigerians or some foreign people in collaboration with some Nigerians, if they decide that this is an approach we will adopt, I think we should fight it. And I'm happy that the EFCC, the Nigerian Police Investigation Department, as well as Central Bank's Economic Intelligence Department, have very strong, credible evidence to adduce fraud, as well as corruption in terms of money changing hands from these disgruntled foreigners and Nigerians. And we have received presidential go-ahead that these people should go through criminal prosecution in Nigeria and in any part of the world. Bloomberg, that the Fed court rates ECB loosening, do you expect flows? Naturally, that should be the direction, and we think that we also need to do the right things for those flows to come to us, and that's why you find that Monetary Policy Committee will try to make sure that we juggle all these issues to make sure that the interest of all stakeholders are well taken care of. Restriction on FX for cassava. Well, you see, the issue is, like I keep saying, it is not new. But I'm also saying Nigeria is the largest producer of cassava. If Nigeria is the world's largest producer of cassava, then we should not allow people to say they want to import starch, or they want to import ethanol, or they want to import sorbitol into Nigeria. We will prevent them from doing so with all our might. Thank you.
Thank you. Thank you, Governor. The answers have been very passionate and logical. Please help us tell the world why we have to go digital in our payment system. It's very important. It is a promised land we all must get to. Thank you very much, as we see you in the next 2 months. God bless you.